Welcome back. Infosys results, the big day. Numbers are with us. Fourth quarter margins and profit after tax are better. Guidance is better. Revenue growth, though, a little disappointing. The top management team is with us here. S.D. Shibulal is CEO and Managing Director at the company. Rajiv Bansal is CFO at Infosys. Thanks very much, both of you. Great to have you guys
here.
Good morning. Shibu, let's just start with the revenue decline, 0.4% revenue decline in fourth quarter. What was that on account of? PAT has been boosted by other income a little bit, and there's a 50 basis improvement in margins. I'll get to margins with Rajiv in a bit, but why don't you start?
So I think let me give you an overview. The revenue for Q4 was $2.092 billion, and it did decline by 0.4%. The reasons are that we had some challenges in CPG area as well as in high-tech manufacturing area. At the same time, year on year, if you look, our revenue has gone up by 11.5% in reported currency terms and 12.4% in constant currency terms. And our guidance was 11.5 to 12%. Margins have improved from quarter on quarter. Not only that, I think margins have improved sequentially from quarter on quarter over the last 3-4 quarters. Utilization has gone up from 70% last year to 76% this year. The revenue productivity has gone up by 1.2%. We have doubled our growth rate from last year to this year. Last year, our growth was 5.8%, and this year, in constant currency terms, that is 12.4%. We have doubled our growth rate. We have narrowed the distance between our growth rate and the industry growth rate. Year on year, other factors, we have very strong client additions. We have added 232 clients. And number of million-dollar clients have gone up from 448 to 501. And we have given a guidance of 7.9%.
You've told me all the good news, all the good stuff. But let me ask you specifically, revenues, the revenue decline, 0.4%. So you warned mid-quarter about it. Let's just
so I'll give you some color on it.
Yeah.
So if you look at the retail and CPG industry, where we get about 15% of our revenue from, they had good holiday sales. But their margins were hit because the holiday sales came at very steep discounts. So their margins got hit, and they have controlled their investments into the discretionary spend.
The retail segment.
Retail and CPG segment.
Right.
If you look at our manufacturing, which is about another 15% of our revenue, a very large portion of that comes from high-tech manufacturing.
Right.
And if you look at high-tech manufacturing, capital expenditure is down, PC sales is down. They are also controlling costs. There are a few accounts where in high-tech manufacturing, we constantly see an uptake in the first quarter of the calendar year. And we have not seen that.
Manufacturing is what, 25 odd %?
Manufacturing is about 17 to 18% for us.
And high-tech out of the manufacturing
would be a very large portion of that.
And that has been giving you trouble.
That has been giving me trouble.
Manufacturing, though, in constant currency is up 0.5%.
It is up by 0.5%, but it is after the impact of the high-tech manufacturing.
Right.
Right. In fact, in Q1 of their Q1, that is calendar year Q1, we will always see an uptake with our high-tech manufacturing. We have not seen that this year. We have also seen some sporadic project cancellations, especially in the discretionary spend in other clients. That has resulted in our revenue being slightly down in Q4, but we have met our guidance, the lower end of our guidance,
which you said it'll be close to the lower end of the guidance. 50 basis points. Margins have improved. I mean, they continue to improve. So, I mean, could you just break this up?
No, so if you look at over the last 6 to 8 quarters, if you look at the last year, our margins were declining as the year progressed. And we ended the year at about 23.5% operating margin. If you look at this year, we started the year at 23.5, but over the year, we improved the margins to about 25.5% operating margin. So that's a good sign. I think all the things that we spoke about, cost optimization, focusing on growth, and everything is working. This is also after giving 2 wage hikes to employees. There are 2 cycles of wage hike. One we gave in July of last year, one we gave in. So I think we are doing well on the margin front. And I think
most of this is coming from controlling costs, right? I mean,
it is also, if you look at the operational parameters, have improved. Our on-site mix has dropped by 0.4%. Utilization is marginally up.
Right.
Revenue productivity is almost flat. So I think if you look at all the parameters, operational parameters are I think, doing well for us. Now, if you look at what you asked me about the non-operating income, see, we had 183 crores of forex gain this quarter as like 119 crores, which has helped us in the non-operating income, which has resulted in higher net margins for the quarter. But I think if I look at from what I see the margin profile going forward, typically in the first quarter, because of wage hike, visas, and promotions that we rolled out in the first quarter, you would see a 250 to 300 basis points drop in the first quarter margins. That is normally which happens on every year in the first quarter. Considering that, we have to still accelerate our growth, we still have to look at every opportunity which is in the marketplace. We would continue to invest back in the business. And I would expect the margin profile for the next year to be in line with this year.
Which is about 24%.
It's about 24%. And this 24% this year is after taking a charge of 35 million in second quarter for visa-related matters. So I would expect the margins to be around the same thing.
So what would earnings be? Earnings per share? Because I've got the margin, I've got the revenue growth.
See, it's very difficult because a lot depends on the forex gain and the non-operating income, right? This year our yields have gone up marginally to 9.45 as against 9.31 last quarter.
Right.
So I think operating margin is the right way to look at about where the business is and what the operational parameters are and how well we're running our business.
Right.
And net margin will depend on how the interest rate movement happens, how the forex changes happen over the year.
Why not? Okay, so let me just wrap out fiscal 14, then I'll talk about fiscal 15. Why not give out a special dividend? There was expectation on that one.
No, we increased our dividend payout to 40%, right? So see, what feedback we have been getting from the investors is that a special dividend they really don't appreciate because there's no predictability on special dividend, right? So
but they love it anyway. Which way?
No, they would have. See, if you don't increase the dividend payout ratio, but they give a special dividend, of course they will love it.
Yeah.
But they would prefer a dividend payout ratio increase as against a special dividend because it brings predictability to their returns. So I think what we have done is we looked at our cash flow requirement for the next couple of years, how much cash we're going to generate, what are the business requirements, where we need to invest, and we felt comfortable that we should increase the dividend payout ratio to about 40% of post-tax profit, which we have done.
Can you give me some more color on Q1, Shibu? How is it going to look like?
So,
because your guidance implies 2.9% growth, Q1 to Q4, fiscal 15.
So our deal pipeline is marginally up. At the same time, the decision cycles have expanded, especially in the discretionary spend. And the discretionary spend is a very large portion of our revenue. It's about 33 or 34% of our revenue. It has marginally come down from Q4 to Q3 to Q4.
I was looking at the discretionary segments, right? Consulting is down 3% quarter on quarter. Products are down about 8% quarter on quarter.
Yes.
The cost segments have done well. Testing, IMS, right?
It's also a reflection of the large deals which we have won because we have been very much focused on our winning very large deals. They are multi-year deals. They take time to realize. The revenue takes time to realize. First year we get about 8% of the revenue. So what you are seeing is a reflection of our focus on winning very, very large opportunities. This quarter we have won $700 million TCV on 4 deals. At the same time, when our clients are very focused on cost. That means that the discretionary spend do come under pressure. Finacle did not have a good quarter. That is what is showing up in the products and platform.
Okay. Can you give me the numbers for Finacle?
Rajiv?
Finacle last quarter was about $80 million. This quarter we've done about $72 million. So it's a decline of $8 million sequentially.
Right. And what is your expectation going forward?
No, Finacle is going to be a kind of, it's not a predictable quarter-on-quarter growth because it depends on the license sale and how you get the revenues and things.
Sure.
So I think Finacle, again, there's a lot of investments happening in terms of the ability to capture the developed markets. So we have to prepare the product for the developed markets, and that is where the growth engine is, the growth markets are. So I think Finacle would continue to underperform the company to a large extent even next year because that's a year of investments. I think after that it should take off in a big way.
Okay. So we're talking about Q1 and Q2. So, I mean, you said that margins are usually under pressure because of wage hikes, etc. But in terms of the revenue momentum, what is it going to look like?
So I think we have given a guidance for the full year, 7 to 9%. And, that will pan out during the next 4 quarters.
Okay. And I've got, of course, the 24% margin for the full year as well, which you said, which is similar to 14. You've said sales, delivery, cost optimization are the 3 sort of focus areas, right? Costs, of course, the focus is showing through. What about sales and delivery? I mean, how long will that start to
So in sales, we are continuing to invest. Actually, we are recruiting 200 people globally from the best universities like Stanford, Harvard, MIT, and they will join our sales force, and that will enhance our sales capability. On the production side, we are very much focused on driving productivity. We are very much focused on driving efficiency.
But by the time these people come on board and they familiarize themselves with the accounts, clients, etc., how long before we actually see them hitting the ground running?
That's exactly what we said. We have said that it will take about 3 years' time. Then we are only into the first year of our 3-year period. The optimizations and the operational efficiencies are easy to bring. So it is not only cost optimization. We have brought in a lot of operational efficiency. Our utilization is improved by 70 to 76% year on year. Our on-site offshore ratios have improved. All of those are cost optimization and operational efficiencies.
Sure.
They are easy to do. They are somewhat short term, whereas change in sales and production are long term, and that will take a period of 2 to 3 years.
Any thoughts, Rajiv, on this one?
No, I think what Shivu said is right. You know, typically, see, when we are hiring 200 people from best universities in US for our sales, it is not about a short-term perspective of how early they would start giving us returns. It is about building up a sales engine which will deliver a sustainable growth year after year. So that's the reason I keep saying that, you know, right now we have to invest back in the business, and we're in the investment phase. So any opportunity that we get to build a sustainable model, we have to invest. And that is what we're doing.
That sales sort of comment gets me to my next question. Attrition, right, has increased again, 18.7%, 18.1% last quarter. That has been a big worry. You've spoken about that in the past. So what are you doing to control that, manage that?
So actually, if you look at attrition, which is at 18.7%, about 1.5 to 1.7% of that is involuntary. So it's about 17%. It is still not comfortable for us. If you look at the last 12 months, we have done a number of things. We have given 2 compensation increase. 9 months back, we gave 6 to 8%. Just now, we gave 6 to 7%.
But just pay increases, wage increases.
Hold on, let me complete. We have done promotions and progressions. We have done large amount of promotions and progressions during the year. We have restructured the compensation. That was one of the big asks from our clients, to restructure the compensation and make it more predictable. We have done that. We have implemented a number of training programs within the organization. We have taken a very conscious decision that we will promote our people rather than bringing people from outside. There's an enormous focus on promoting our own people. We have implemented a fast track program in the company whereby high performers can move up. We have given very high variable compensation to, and that means we have given the variable compensation to CRR1 and CRR1 plus almost 100%. So we have done a number of things.
Is that a top priority, sort of?
It is one of the most
attrition?
important things in our life. You know, our employees are the biggest asset which we have, and we have to make sure that they are here. So we have done a number of things. There is a tail effect, right? The things have to be done, they have to sink in.
How long before attrition drops back below, say, 18%?
So we are expecting that all of these things which we have done will have a positive impact on our attrition, and attrition will move in the right direction.
Rajiv, how long before attrition is back below 18%?
I hope next quarter, but you know, we have made all the investments in employees. I think the growth is also very critical because employees see their growth opportunities and their career growth with the growth of the company, and that is very important.
But it's like a loop, right? I mean, so senior attrition, Mr. Kakal was the 9th senior exit, but also mid-level, I mean, people leaving, that in turn sort of affecting growth, that in turn sort of demoralizing the company. At the same time, you're trying to effect this turnaround. I mean,
I think one should put all this in perspective. If you look at senior attrition, we are about 160,000 people. If you look at the leadership role, even if I take 1%, that is 1,600 people, and we are talking about 8 or 9 people. And
Shivu, there can be 160,000 people, but there's only one CEO, right?
That's true. But there are hundreds of people who are quite capable of being CEOs in this company. Let us not forget that. And we have instituted this leadership institute program 10 or 12 years back to make sure that we have the deep leadership pool. And every one of those changes we have implemented timely without impacting the clients. So that is also very important, that we are able to transition it effectively when there is an attrition.
So you said, and I'm going to hold you to that, what you said just 2 minutes back, you said that we are focused on promoting people internally. You are you want to step down earlier than your retirement date. What prompted that, Shivu?
First of all, it was important to give clarity because my date is fixed because of my superannuation. The January was the board meeting just before that date. So what I have said is that either I will step down in January or at the earliest point when the nomination
committee... When a successor is found.
And that is because the nomination committee has started the search, and it was important for me to give clarity on my plans, and that's exactly what I have done.
No, but you are, I think your retirement was due in March.
That's true.
But you're saying that January or earlier.
Based on
what should we read from that?
Exactly what I said.
Which is what?
What I said is that I will either step down in January board meeting.
What is the thinking? Is the thinking, as you said earlier, when you said that we're very focused on promoting people from within, right, instead of bringing people from outside, that holds true for the top job as well?
So that is a question to the nomination committee. But the more important question which you should ask is that the right capability is required. That's the most important decision to be made. And the nomination committee has to take a decision who should be the next CEO.
Right. So you won't tell me who's in the pipeline. Rajiv, any thoughts on this? Because not Shibu, but the senior management exits and how that is sort of impacting, because it has got to show up. I mean, you can say there are 160,000 people and only 9 exits.
No, I think you have to look at.
yeah.
I'll agree with Shivu. You have to look at it in the right perspective. 9 people in a 160,000 people company is okay. It's we have a deep leadership pool, and
Doesn't that have a trickle down effect?
not really. That's what I'm saying. That's the strength of the organization. The organization has been built over years. You have developed people, you have developed leaders, you have given them the opportunity to come up and participate and contribute to the company. And they are very capable people who can take up the high leadership role at the earliest. So I think the company has created that kind of ecosystem where it encourages people to come up. So I'm not too worried about a few senior management exits. I think we have to handle this whole transition very well, and that is very critical. And I think nominations committee and the board and the senior management is doing everything possible to ensure the transition is smooth. Everything is the business momentum is continued, the investments are made, and we deliver well.
Fair enough. Rajiv, Shibu, thanks very much, both of you. Great to have you guys here. And I hope to see you next quarter. Shibu?
I look forward to seeing you again.
Thanks very much,
Thank
both
you.
of you. Appreciate it.
Thank you.
Thank you.
That's the CEO and the CFO at Infosys.